Go to webinar control.
Good morning to all of you. This is Ranjan from smartfinancing.com. In this particular presentation, I am going to describe one very good option strategy, so which you can benefit from, and it is based on a concept of theta yield, means from theta to take a maximum yield. Sometimes you need to take the delta yield also. This is based upon a very advanced concept. So normally people think that option strategy means it is a saddle, strangle, god, condor, iron condor, and etc. But that normally doesn't work. To be successful in the option strategy, you must be very good in your option Greek understanding, and you must study from the authentic sources. Authentic sources, once I am saying, somebody who is skilled, somebody which is having a unique understanding on the Greeks. From there, if you study, you can able to make money in option strategy. So smart finance, which is in this domain from the more than 20 years. So we have an excellent course on the option strategy. If you like, you can procure it, you can learn from the basics to advanced concepts. So first, we'll learn one strategy and we'll decode on that strategy, as well as it will also will backtest on that strategy, how it works and how it is going to work. And before I go to that presentation, I am going to give you one announcement. We have scheduled an excellent program on the WD GAN and option adjustment. Normally on the option adjustments, you do not have any book which can teach you the adjustment. So this is as a part of our research. These are the 5 different adjustment principles you are going to learn in this program. Program starts on 24th of May and it is having 6 sessions, each of 1.5 hours, and it is first day in English, same will be repeated in Hindi, like this way, and a lot of WD GAN concept in practical ways you will learn in this program. So if you are viewing this video, refer the description where you can get that link to register or to visit this page, you will get it. So now I will proceed to the strategy. So the strategy will be looking like this, and this particular strategy take around 2 lakhs rupees of margin, because nowadays margin has gone up. So when we are configuring this strategy, Nifty spot is at 24,700. So this is the level Nifty spot is trading. So what we are doing here, long dated, means we are in the month of May, June, July, August, September. So 4 months I had the line. So we have September contract. So I am buying the September contract 25,000 call and put. So to avoid the confusion, same strike call and put I am buying for September. So this is the premiums reflecting here, and it is having the lot size as proper here. So till this point it is clear, and if you compare with the current Nifty spot price, the one put option is ITM, another call option is OTM with respect to this particular Nifty spot. However, you'll be seeing something surprising here. One OTM call which we are defining with respect to the current Nifty spot is at a higher premium, and one ITM put which is respect to current Nifty spot value, it is at a lower premium. Nothing to surprise here, because the future maintains a premium month on month basis. So based on that, so the longer dated options will always consider the future as their reference price. So for September contract, the 25,000 call option is in the money and 25,000 put option is out of money with respect to September, not with respect to the 14th of May 2025. because future maintains the premium. So that is a different subject. Once you go through my courses and all, you can understand. So for easy understanding, this is being done. So this is being done. This is being bought. This is being bought. Fantastic. So now what we'll be doing every week the same 24,700, because now we are at 24,700. So every week we'll be selling a call option and put option of weekly contract starting from 22nd May, because we have expiry tomorrow 15th May we have expiry, so that only one day is left. So we will leave it 22nd May expiry will sell. And on 22nd May, we'll again go to the 30th May. And on 30th May, we'll again go to the June first week, whatever the expiry comes. Then like this way, we'll keep on selling the weekly option, irrespective of market move. Let market to go to 25,500, let market to come to 24,000, let market to come to 23,000, 26,000, anything happens. Strikes are fixed. This put option and call option we are going to sell, and this is already bought for the September. One time, this is the 4 leg we have entered, but next onwards we are going to repeat this thing. So this is what will be our strategy. So now move to the back testing of this strategy. So similar way, 23,700, 23,742, the Nifty underlying was on the 1st of January 2025, and I bought 24,000 call 1184. That time spot was 23,740. I bought the June month's contract at 1184. Similar way, put also I bought at 640, 24, and 23,700 call and 23,700 put is being sold for 9th January expiry. So this is what in 2 different Excel sheets I have maintained. So here, first what I am doing, same thing here, you are having 25, that time market was 23,742. So 24,000 call and put for the June month is being bought, and 23,700 call option and put option of weekly option of 9th January is being sold. Fantastic, it has happened on that, on every, on 9th, again what we are doing, same call option or put option we are selling here. So we are closing here, some losses we are taking, we are selling again this thing, again some losses we are taking, again same thing we are going to put, till we are going on selling these things till 27th of February. So 1 month January will get over, February also 4 weeks is getting over. So that time, during this period from 23,700, market has tumbled down to 22,504. Almost 1,200 points of fall happened. And if I just, because every week basis I am just selling, taking a loss, sometime profit, again loss, profit and other things. But this side is constant, because this particular put option I am not changing anything. It is notional. I have said that underlying price notional loss of 24,000 put options of June. It is put option of June. So this is notional loss, because this we are not closing. So on 27th of February, if we are closing this trade, so what will happen? The put option which we bought at 640, it will be trading at 1185. So we will be making a profit of, so here we will be making a profit of, so here I am just going for F2. So here I am making a profit of, there is 1,500 points of fall. So we are making a profit of 40,000. However, this process of selling the things, 33,000 we lost, net 7,000 we get. What happened to the call side? That is more important. So call side, what we have taken, call we have almost lost 67,000, but call, most of the call option whatever we have sold here, it has already given 65,000. So net we are at 1965. 1965. So by this process, what happened? Only 8 weeks are gone. But in between something happened here, because these options become worthless, become 13 rupees, 5 rupees, 1 rupee 45 paisa. So there is no point in selling this call options here, because once it's coming to 13 rupees, from 168 rupees to 13 rupees, so we could have closed here. So this point, till this point, we are having 63,000 rupees of gain. And here on notational basis, if I can take, so here once this is 168 rupees option becoming 0, and by this time we have already gained 63,000, and 23,000 we are losing in the call option, 40,000 full gain we are making. So call side we could have closed by that time, but maintaining a consistency, I made it here. What could have happened if the same is being closed here? So you can say here, so if it is being closed at 6 to 2025, what could be the net profit we could have get? So here, sum of whatever the call option profit we are getting from January to the 6th February, I sum it of all. So this is what we have gained, and we are also having a loss, which is a, if we are closing this position here, 40,000 rupees we will gain in the call side. What could be the result here? So you can say here we are having, so here net basis after 6 or 7 weeks you are getting this thing, but 1,700 point of fall happen. So if it is just in that band of 1,000 rupees up and down, so here you can see this process till this point, till 6th of February, we made through the put option weekly sale this much, and we are making the some amount of profit here, some amount of profit here. So so here, so you can say totally we can make it here at, because there is no point in selling a worthless option, 3761 and call side 40. So 43,671 we can make. So here point, you have understood all these things. So what is the best time to quit this strategy or book the profit? And what are the adjustments are required in this strategy? The adjustment principle of this strategy you are going to learn in the webinar if you are joining that. What is the best point of booking the profit? So you are selling the same strike call option and put option, 23,700 call option and 23,700 put option is being sold in all weeks. One fine time, whenever you are finding out either the call option or put option, say after selling for this 13th February call option or put option, we identified that this call next week, that is on the 20th February call option of this 23,700 is worthless. It is not having any value. It is mere 13 rupees value. So whenever this call option will become the next selling of call option become worthless or put option become worthless, that is the time you should book profit and come out. So here the ideal time to book the profit on 13th of February, because 20th of February option is only 13 rupees here. In fact, the put option will be having a great value here, 650 or 660 rupees. So we don't, because one option become worthless, so there is no point in holding this strategy. Rather, we can change the call strike and put strike and sell some option which is having money worthiness, theta worthiness. So that is a different process. However, the best time to book the profit will be when any of the sold call option, the future sell, if you are selling at 168, 169, it has or 30 rupees, 50 rupees, that also has a value. But if it is going to 5 rupees, 10 rupees, it is not worth to sell those options. Even your brokerage and taxes will not come. So this is one of the strategy how you can form. So you can interpolate this strategy in different ways. So I have taken one in the money and one out of money. You can take both in the money. So by same strike, maybe different strike you can take. You can take 25 call, 26 put, or 25 call, 24 put. So different strike also you can take, interpolate and get better result. And if you use the any of these adjustment method by profit capping or delta capturing or chain adjustment process, then your profitability will be more. But that depend upon your study. That depend upon your engagement in this kind of. But looking at the margin percentages, whatever the margins we are paying for this particular strategy, the final margin which is 2,28,000. So after 3 to 4 weeks or after a 500, 700 point move, so after 4 weeks or 700 point of plus or minus movement, if you are getting 25,000 gain also, that is equal to 10% return. So for that reason, you need to look into in terms of return on your margin, number one. Second, you need to see that whether to keep on holding on that strategy or to book the profit and go for a new combination. So these are the things depend upon your expertise on this strategy. So if you join this program, like such, some strategies you are going to learn with respect to its adjustment principles, and that depends your engagement, your involvement, your commitment, your studies on the strategy. And that studies required a qualitative studies, not a quantitative studies. If you are already well satisfied with your saddle strangle god conduct, then this program is of no use for you. If you are well satisfied with the narration that nobody makes money in option, then this program is not for you. If you are already bought into that idea, just nothing will work for me, then this program is not for you. This program is only for the people those who think money can be made in this market, and I have shown you with the backtesting data. Again, I am showing this screens, and this particular screen graph you can keep it. So here one small error, I can just fix it off. So here small error, I can fix it off. So you can see here the if we can hold till 6-7 weeks, we are not getting much gains and other things. And here, if we are not holding into the factors, and whenever any option or the future selling of that call or put is becoming a worthless sell, not a money worthy sell, if you are quitting the strategy, we are getting a good gain. Even the part of this gain comes, that also is a great success. Half of this gain also comes, that also work out to a great success. So So this kind of strategies, by learning only you can make money. So for that you have to give a commitment, you have to learn, you have to analytically think on these things, then only you can make it. And if all those things are not possible for you, then strategy is not your cup of tea. Strategy requires lot of commitment. Commitments in learning, commitments in testing, commitments in understanding, commitments in analytical thinking. So these things attributes to the success of your strategy trades. And To get more on the strategy, if you have this course, go through that. If you do not have, procure it and go through it stage by stage, step by step, so that you can understand a lot of strategy. And if you are committed enough, do not miss this program, because this type of adjustment techniques, it is hard to get anywhere or difficult to find out in anywhere. Thank you very much. Thank you for your time.